Hey guys, so basically today we're going to be talking about the three major types of firms or businesses that we have here in the US. And these three major types of firms are a sole proprietorship, a partnership, or a corporation. So let's kind of go and dig a little deeper into the differences of these three. So what a sole proprietorship is basically a firm that is owned by a single individual. Owned by one individual. A partnership is a firm that is owned jointly, basically by two or more people. But all of these three types of firms are organized a little differently, and we'll go into that a little later. So, owned by 2+ people. And then lastly, a corporation is a firm that is created under the law as a separate legal entity. Basically, here, owners are provided with protection from losing more than their investment in case businesses fail. So they are separate legal entities. So let's dive a little deeper into each of these and see what we can get in terms of, I guess, kind of advantages and disadvantages. So as I said earlier, sole proprietors are owned by a single person, and basically the biggest advantage here is that it's easy. You are the business. There's no really legal separation, so you are the business. So that kind of makes things a lot easier in terms of paperwork. There's no legal separation. The business's profits are your profits. The business's debts are your debts, and their income, and the business's income is taxed as your own personal income. So that's an important one. Business's income is your personal income. So that's very, very important in this case. The lack of separation is also like a huge disadvantage in terms of you being responsible for debt, taxes, any other financial obligations to the business, legal, etc. So what this is called is having unlimited liability. So now let's move on to a partnership. So in a partnership, it's a company that's jointly owned by two or more people, and these people share rights, responsibilities, and this should all be spelled out basically in a partnership agreement. They also have the benefit of simplicity as do sole proprietorships. Partners are going to be taxed on the profit, whether or not they actually get it in cash or not, and basically partnerships don't pay income taxes themselves, but they file a tax return showing how much profit they made, and then if they made any profit, they pay income taxes on that profit. That is basically their personal income. So here, pay taxes on the firm's profit as personal income. So there we have that there. And so in a partnership, even if the money is reinvested back into the firm, you still have to pay taxes. In any partnership, at least one person must be a general partner, and then this person will have that unlimited liability. At least one person will have that unlimited liability. So now let's move on to our last type of firm/business, which is the corporation. Corporations are set up pretty differently than the other two here. They are separate legal entities, and it's owned by shareholders. So this form of ownership protects its owners, and then this is known as limited liability. So basically what this means is you can lose the money you invest in the company, but other than that, the debts and whatever other financial obligations belong to the corporation, not the owners. So liabilities belong to the firm, not the owners. That's kind of the key advantage here. But on the other hand, corporations have to pay income taxes on their profits. And incorporating also kind of has legal issues, articles of incorporation. It's less simplistic as the other ones. And on top of this, any profits distributed to the owners as dividends kind of also get taxed, so you are subject here to double taxation. But there you have it. These are the three types of major firms in the US, and this is kind of their major advantages and disadvantages.